In today's video, I want to talk about a situation that happens very frequently in any market and in any time frame, which is what I call flow shift in the fractal flow jargon. If you have some trading experience, you must have noticed already that sometimes you keep waiting until price reaches a certain point in the chart that satisfies your analysis. When price finally reaches that point, it does something completely different than what you expected, leaving you frustrated and confused. This relates to one of the flaws of technical analysis. This type of analysis is visual, so traders are highly susceptible to cognitive errors associated with sight. The situation where you focus too much on one point in the chart is nothing more than a cognitive bias that blinds you to everything else important that happens in the chart. That means that you not only get your analysis wrong, but you also miss a lot of opportunities along the way while you are waiting for price to reach a specific level that you found in the chart. It's actually even worse than that, because when you realize that you were wrong, you miss yet another opportunity that arises from the fact that you were wrong. So in reality, you miss the opportunities before and after the point in the chart that you were focusing on too much. We like to think that we are rational creatures and that we analyze things impartially, but that's far away from what really happens. This archetypal situation I just described in general terms is just one example of that. There are tens of situations like that in the market, and as I often say, most technical traders don't pay attention to these either by negligence or ignorance or a combination of both. This is why it's so important to understand all the relevant cognitive bias that affects traders. You can find that in the Fractal Flow Strategy video course in the link available in the video description. The first step into developing the impartial spectator sense is to first know the biases so you can sense them as they emerge, or you can avoid putting yourself in situations where they are certain to override your willpower. In this chart in front of us, we have a good representation of the situations I have been describing in this video. We can see a clear solid high in the major flow of this market, and that immediately suggests an inward frequency line that could act as a possible short trade idea. That of course would depend on other factors beyond one technique alone. If you are a trader looking at the price before it starts to come back up in the direction of that inward frequency, what happens is that you immediately start to focus on that area alone, and everything else in the chart becomes secondary. This is almost like a tunnel vision, but a lot subtler, unfortunately. Otherwise, it would be easier to avoid it. When price finally rises enough to that level, it breaks the high that was not supposed to break according to the analysis. And then the trader begins to get confused. The confidence level in the technical aspect of the analysis begins to drop, and the cognitive biases and irrational behavior begin to elevate. This might not seem like a big deal, but this change in confidence in the method is a serious problem. When you deal with your own money, you want to have the confidence to act logically. So when a surprise happens, traders tend to go to one of two extremes, either risk aversion or risk-seeking behavior. Now let's begin to notice the subtlety of the market and how those who pay attention get rewarded. Observe that right before price broke the major high that was the main focus of the analysis, it started to create a tiny minor flow to the upside. Nobody in their right mind would try to trade that when price is in the mouth of hungry sellers from the major high. At least that's the theory. Nobody would think about trading that because of the expectation that there was strong sellers in that major high. However, the expectation was clearly frustrated, so it logically follows that the tiny flow to the upside is tiny in its appearance, but it's more relevant than the major high that frustrated the analysis. This is the initial dynamics of a flow shift, which received this name for the obvious reason that the market was developing a certain flow, and all of a sudden, the flow reverses to the opposite direction. The following step, which is the one that most of the market doesn't get, is that price remembers the moments of failure, and it usually comes back to it to give an opportunity, but with the switch signal, so to speak. What everybody was expecting to be a short trade was actually a long trade. Notice that after the breakout of the major high, price starts to come down, stops at the inward frequency line of the minor flow, and creates a clear hybrid bar. That's exactly the chance to get into the long trade with a stop below the minor solid low. This is a situation where a stop near a minor extreme makes sense. If that wasn't enough, after this great first opportunity, price starts to developing a running flow, and it comes back to the slightly higher inward frequency line once again. Pitchforks are tools that work especially well in running flows because of the overall trending angle is not too steep. By drawing a standard pitchfork in the relevant and alternating market streams, we can spot a few details. The first thing is that price immediately starts to drift away from what is supposed to go according to the pitchfork theory. At the same time, we have clear validation in the pitchfork tail. By using the reverse engineering principle of price action, we can transform this standard pitchfork into a modified shift one, since we already have a good idea that price can go back to the inward frequency line. When we turn the standard pitchfork into a modified shift fork, we can see how it correlates with the inward frequency line, and that's your second opportunity to enter the market. It's not difficult to recognize how different this is than trying to keep shorting the market out of pure stubbornness or revenge. In trading, we have to literally go with the flow and let the market tell us what's going to happen next. I know that this sounds like terrible, superficial advice, but in this case is actually true. As I said in the beginning, this is just one of the many examples of specific market scenarios that can become counterintuitive and confusing. I developed several courses about price action, so you can learn all these techniques and situations in great detail. If you have interest in learning about such ideas and steering away from the outdated and frankly superficial knowledge about technical analysis that is out there, I invite you to check out my courses in the link available in the video description. If you enjoy these videos I produce and wish to support their continuous creation, you can support the channel by clicking the like button, subscribing to the channel, activating the notifications button, sharing the video with your community, and leave your constructive feedback on the comment section. Thank you very much for watching, and I hope to see you in the next video. Take care.